Mayuresh Joshi also with us on the show. Mayuresh, any first thoughts on UPL or any other specialty chemical name that you like?
Afternoon, Anisha. No, I think numbers tad below par for UPL. Obviously, I think the description that you just mentioned, the Advanta business, the seeds business has done relatively better, but they are seeing pricing headwinds, specifically in the crop protection business. Now, within the geographies that they probably operate out of, you are seeing some scenarios where there have been instances of floods in a few European countries as well. And therefore, I think how does this revenue build up, specifically in the second half that they're maintaining their guidance, and specifically on the EBITDA front, is something to be watched out for. Obviously, I think the net debt has increased, not in proportion to what it was last year. But compared to the other agrochemical players, Anisha, I think the other agrochemical players who are more domestically focused have actually given a better set of numbers. Have a look as an instance for Paradeep Phosphates. They have given a good set of numbers, not just in terms of top line, but they're also expected to complete their entire backward integration as far as their entire sourcing is concerned. And therefore, as the phosphoric acid component also gets added in terms of the vertical integration that their plant will probably achieve, one can probably expect better numbers going forward with a very robust balance sheet as we speak. Also, in the case of Sumitomo Chemical India, as an example, I think very decent set of numbers. Top line increased quite substantially, almost 980 odd crores. EBITDA margin expansion was very, very profound, 24.8%, if I'm not mistaken, compared to 20 and 19 odd percent year on year, quarter on quarter. And the management seems very, very optimistic for the second half. With the monsoons we've seen and a good Rabi output season, that can probably be expected as well. So my take is that the EPS ratings for UPL probably look a little bit weak as we see in markets with India. Their peers can probably do well, Paradeep, Sumitomo Chemical, as an example.
Okay, that's the take coming in right now on the specialty chemical space in particular. Haven't seen any resurrection irrespective of the guidance for UPL. The stock is still down and out. For the Nifty, of course, it's largely flat. But given that most of the earnings are behind us right now, Mayuresh, how is it that you've spotted your winners within the pack, and anything that you may have recommended to buy in the last 1 month in the market volatility?
Good afternoon, Aisha. I think banks did surprise us to a large extent because we were of the opinion that there might be some stickiness when it comes to banks, whether large caps or mid caps. Leaving aside a few of the banks, I think a large part of the banking universe has probably surprised on the positive. So Karur Vysya Bank, as an example, from the mid cap space, Bank of Baroda, is something that we continue liking, and as a disclaimer, holding in our global portfolios as well. Housing finance companies surprisingly have given good set of numbers as well. So PNB Housing, Canfin Homes, a large part of their overall component, as far as their balance sheet construct is concerned, is largely retail focused. And you've probably seen asset quality pressures actually come off quarter on quarter, year on year. Case in point being PNB Housing. In fact, NIMs have showed some element of stability for both these housing finance players as well. So as the interest rate cycle evolves, even in the Indian context, I think these NBFCs might actually benefit from earnings as we go into the next few quarters as well. From a domestic cyclicality point of view, as I just mentioned, I think a few of these agrochemical players had a decent show, and the expectation largely is that with better reservoir levels, expectations of a good Rabi harvest, the next few quarters might be equally good. Something on the watch list that we've probably kept, something like a Swaraj Engines. Again, the theme in terms of rural expected to do well, better than urban from what we're hearing from FMCG commentaries, better MSPs that have probably been meted on better output. Might probably mean that tractor sales will improve, as we've been hearing from commentaries of M&M as well as Escorts. Swaraj Engines, I think, has given a very, very decent show as far as their part of the business is concerned. Year on year, quarter on quarter has been stellar. Margins have been stellar as well, and we expect this performance to continue. A little bit defensive as well, Aisha, to a certain extent, and therefore Syngene from the pharma pack has given a good set of numbers as well. Our own sense is that their positioning within the CRO, CDMO space, expectations in terms of small molecules, biologics, actually expected to do well, can actually augur well in terms of their overall business outlook as well. So a little bit skewed towards the domestic cyclicals.
Okay, point taken. You were talking about Syngene, so I wanted to check about Biocon as well. If you have a view there, the stock is doing very well, about 8% higher, getting that VI status for the Bangalore facility. But what's the sense on the stock price from here on?
think, Anisha, I think the response has primarily been because of the status approval that they probably got. But between the two, my own sense is that from a numbers consistency perspective, with the kind of client additions that Syngene has probably added over the last few years, and it's a very, very difficult business to get these Fortune 500 customers to your books and probably ensure stickiness stays with you means that you have to do qualitative work, which they have been probably doing. The kind of scientists that are working on a lot of different CRO, CDMO projects actually also augurs well. And they've created a nice funnel in terms of the pipeline, both from a CRO, CMO, CDMO, biologics, big molecules, small molecules perspective. Biocon to a certain extent, I think numbers are very, very patchy. One good quarter followed by two bad quarters, and therefore the consistency in numbers delivery still not coming through. I think this is a positive surprise that has come through. Let's see how the numbers stack up. But at this juncture, I think Syngene probably remains as a better player on our watch list compared to Biocon.
Okay, that's the take coming in right now on Biocon as well as Syngene. But clearly, this quarter has seen more hits, more misses rather than hits, especially, banks with microfinance and unsecured loan book exposure. They're the ones which have really taken it on the chin. Large private sector banks, of course, like the likes of HDFC Bank, Axis, have remained quite immune to the system. The biggest downgrades, of course, came by for a Manappuram Finance, for a Spandana Spurti, Credit Access Grameen. These were companies which within the MFI segment have seen quite a bit of pressure in the second quarter. Mayuresh, suffice to say that it's a big avoid right now for MFI.
Yes, and with the regulatory, I think concerns still hovering around them, Mahesh. I think there is always this fear that if there is some regulatory action that probably comes through, there might be some element of doubt on how these balance sheets might probably how they might probably evolve in terms of earnings if some restrictions are put in place. And therefore, I think within the space, as I said, a few of the housing finance companies have done well. We obviously at MarketSmith focus on leadership stocks. So within NBFCs in the broader universe, from a rural discretionary spending perspective as well, and playing the rural theme as well, Chola Investment and Finance can also be a good bet. Our own sense is that the kind of exposure that Chola probably has, the kind of pedigree that it carries via its parent, the capital adequacy that it probably carries in terms of its Tier 1 ratios, asset quality pressure is expected to come down as the rural economy actually improves. And as the efficiency starts coming through in terms of the collections, as we head into the next few quarters, that will reflect very, very positively in terms of asset quality pressures, A, coming off, B, provisioning, lesser provisioning probably required on the balance sheet as well, which might give an impetus in terms of the bottom line growth and improved ROAs and ROEs. So if I have to take a bet within the space and the broader NBFC universe, yes, microfinance, not at the juncture, but some qualitative stocks like Chola can be on.
Can't help but talk about Asian Paints, of course. Mayuresh, the day began with that gap down and it really hasn't gotten, bought into at all. The stock has struggled about 8 to 9% lower throughout today. What's the take now on the paints sector per se, and of course Asian Paints as well?
So for the sector as a whole, Ash, I think a large component in terms of demand-led volume recovery has to come from both urban as well as semi-urban stroke rural areas. We've clearly seen that urban areas have been struggling in terms of consumption patterns. There is expectation and hope that there will be a revival in the second half as we speak. And therefore, with a lot of weddings expected to come around, you've probably seen the festive season kick off as well. And therefore, Q3, Q4, from a demand perspective, should probably hold out for the sector as a whole. But two things which probably, again, offset these positive impacts that can come through. A, competition intensity is here to stay. And therefore, the kind of rebates that can still be there in the system for a large player like an Asian Paints as well can trickle down to the entire ecosystem. And therefore, I think competitive pressures across the paint universe, whether you're talking about distempers, enamels, entry-level paints, might actually continue. Second, I think input costs have shown some element of stability. But if there is some element of stickiness that still probably remains on this perspective, margins might still remain a little bit under the pump. And therefore, our take is that on the consumer discretionary side, much better players, paint sector might actually consolidate at this juncture.
Okay, that's Asian Paints in trade for you, still struggling, 8% lower. In fact, we spoke with an analyst as well, Kaustup Pavaskar from Sher Khan. He expects near-term pressure on margins for Asian Paints to continue and adds that crude price movement, along with Birla Opus's market share, will be factors to look out for going forward as well for Asian Paints.
See, obviously we have seen last 2 quarters have been weak for Asian Paints. Even we have seen in quarter 1 also there was decline in revenues and even the volume growth was below than what the expectation is. Q2 also was was quite disappointing for the Asian Paints. Now, it depends on how the demand environment is shaping up, especially in the festive months. We need to understand whether there is a pickup in the demand, and that will help us to understand how the volume growth momentum would be in the coming quarters. Obviously, competition is there in the market, and every large player will try to gain market share or to maintain market share. Birla Opus definitely is a new player. Will definitely try to gain share from some of the large players. So, it is still, we need to see how the performance would be in the quarters ahead. But in the near term, obviously, there would be pressure on the margins, considering the fact that there is a volatility in the crude prices. Also, companies would be spending on, promotional and, higher media spends, basically, to maintain their, shares in the market. So,
Okay, that's the take coming in on Asian Paints. Still a struggle for that stock. But let's get in some BTST trades going. Naresh, what's it looking like? What stocks have you picked out for our viewers?
So first is the buy on REC. The stock gave a breakout, has pulled back a bit, giving a good entry point. Stop loss at 518, target price of 540. Second is the buy on Wipro. The stock is breaking onto new 52-week highs, finally showing some strength. A stop loss at 570, target price of 585.
Okay, that's the take coming in on some of those stocks which are looking good. Capital goods, of course, if you were to analyze the earnings so far, exports have remained weak because of, geopolitical tensions. So most of these, West Asian economies, with exposure to West Asian economies, some of these capital good companies have struggled a little bit. Having said that, Mayuresh, for L&T, does it continue to be a buy?
So we continue maintaining a hold rating on this, Aisha. Again, a large part of their order book is domestically driven. Their overseas order book largely driven by heavy engineering and hydrocarbons, primarily based out of the Middle East, which still seems to be going at a decent pace at this juncture. And therefore, I think the kind of construct that we probably got from the numbers, working capital days have come off. You've probably seen some element of improvement thereof as well. And expectations of the management in terms of how the margin performance will be across their business segments, including heavy engineering, including defense, including hydrocarbons. And therefore, I think orders should keep on continuing in a decent manner as far as the domestic order book is concerned. They will be executing at a decent pace as well. And therefore, I think within the capital goods universe, as a proxy to different segments of the markets that L&T has exposure to, and some high growth elements and segments as well, this is one stock that if you continue holding in your portfolio, you should continue.
What about Reliance though? It's lost about almost over 4 lakh crore rupees in the market cap since the peak in July, Mayuresh. I mean, what's been ailing the stock?
So actually, again, if you look at the business segments, right, if you look at the retail-oriented businesses, specifically Jio and Reliance Retail, I think these businesses will continue doing well. We're heading into the festive season, so the next 2 quarters for Reliance Retail should be relatively better. Obviously, the kind of stores that they've opened in the past few months, as the utilization levels picks up and as fixed cost absorption starts taking place into the system, I think the relative performance should be better. For Jio, again, we've seen and heard that the subscriber base has come off. They're losing customers to BSNL, but I think it's those low subscriber customers that are probably going off, and therefore the ARPU that has gone up should show consistency for the remainder of the qualitative customers that they probably got, and therefore Jio should have a steady showing going forward. What really gets offset, Aisha, is their upstream business and the petchem business itself. With crude prices under the pump, the expectations of Singapore GRMs remaining a tad bit under pressure would probably mean the upstream business might face some element of headwinds as we head into the next few quarters. Even though they have optionalities in terms of feedstock, that can still create some element of risk in terms of the compounding of earnings for this segment. China recovery still doubtful at this juncture, and therefore the petchem business, the spreads that we've probably seen and the deltas that the petchem business operates out of, the end product prices still seem to be very, very soft. And therefore, even this leg of the business segment that Reliance operates out of can be a little bit soft, which offsets the kind of stability that the retail businesses offer. Obviously, hydrocarbons, biogas, the new energy businesses, some while away. Long-term story, very, very positive. Short-term headwinds probably offsetting tailwinds at this juncture, and therefore the price correction.
Okay, Mayuresh, we'll let you go on that note. Naresh, thanks as always as well.
If you like this video, then like, share and subscribe to ET Now.